Tesla stock is currently trading intraday at $408.87, registering a sharp upward move of 4.62% as buying volume surges across major exchanges. While the immediate expectation from this price jump is that retail enthusiasm is simply returning to electric vehicles, the reality is far more complex and tied to a massive corporate event taking place outside Tesla itself. Wall Street is aggressively shifting its focus toward the upcoming NASDAQ debut of SpaceX, scheduled for June 12th at a target price of $135 per share, and institutional desks are using Tesla stock as a proxy vehicle to position themselves ahead of the listing. This creates an entirely new dynamic where the electric vehicle business model is taking a back seat to the broader Musk corporate ecosystem. The market narrative has long positioned this company purely as an automotive manufacturer struggling with margin compression, but the underlying reality reveals that capital is treating it as an open-ended technology fund. For any retail investor looking to self-investing options, understanding this specific dislocation between what the company reports on paper and how the market actually prices its shares is essential before deciding to invest online. When you look at the general market belief, most people think this massive price increase is driven by a sudden turnaround in global delivery numbers or stabilization in automotive margins. The retail crowd assumes that because the price is pushing past $408, the core vehicle business must be clearing its hurdles. But when you challenge that common ground with a deeper look at institutional order flows, a different picture appears. Major financial firms like Fidelity Investments have recently lowered their investment thresholds for the upcoming SpaceX offering down to just $2,000, which has triggered a massive wave of capital realignment. Large institutions are building significant positions in Tesla stock today because they are anticipating a major halo effect that could lift all related assets the moment public trading begins for the space enterprise. This creates a fascinating tension because the fundamental reality of the company's recent first-quarter report showed negative free cash flow due to a staggering $25 billion capital expenditure guidance dedicated entirely to artificial intelligence compute and robotaxi infrastructure. The average investor is buying the stock expecting a traditional auto recovery, while the sophisticated funds are trading it as a high-stakes call option on autonomous robotics and cross-company corporate synergy. Looking closely at the recent daily swings, the stock has carved out a highly volatile intraday range between $394.72 and $412.94, with trading volume easily eclipsing 50 million shares. This level of institutional activity shows that the stock is experiencing significant accumulation after hitting its recent 52-week low of $281.85, even though it remains below its 52-week high of $498.83. What is driving this intense volume is a major structural shift in analyst sentiment, highlighted by a massive house upgrade from JP Morgan, which lifted its 12-month price target all the way to $475. This single revision completely reframed how the street views the company's capital-intensive spending, moving the valuation model away from traditional car deliveries and shifting it entirely toward autonomous driving networks and humanoid robotics. On the technical side, the share price has been battling a fragmented moving average cluster, trapped between its 50-day simple moving average near $395 and its 100-day moving average near $403. Today's massive breakout past those resistance points shows that the buyers have completely taken control of the near-term momentum, brushing aside concerns regarding the margin compression seen in the latest quarterly data. To fully understand why this is happening, we have to look closely at how modern online investment platforms handle these massive capital flows. Whether you look at retail order execution on the Robinhood app or institutional block trades routed through the Interactive Brokers platform, the liquidity flowing into this asset is immense. For anyone looking for investment help or exploring various investing sites to manage an individual brokerage account, the massive divergence in analyst targets from $25 to $600 highlights just how polarized Wall Street remains. On one side, you have traditional value managers who look at the company's current price-to-earnings ratio of over 370 and see a stock that is completely disconnected from economic reality. On the other side, growth managers utilizing sophisticated active investing tools see a company that is successfully absorbing billions of dollars in capital to build an unassailable lead in real-world artificial intelligence. Comment below how many shares of Tesla stock you currently hold, or if you are planning to adjust your portfolio ahead of the upcoming market catalysts. This baseline tension between near-term fiscal pain and long-term structural dominance is exactly what keeps the intraday volatility so incredibly high. When we strip away the massive trading volumes and look at what the company actually does, the core business remains centered around designing, manufacturing, and leasing fully electric vehicles, energy storage systems, and solar power generation equipment. The business model relies on generating high-volume automotive sales to fund the high-cost research and development required for full autonomy and network services. In past performance cycles, such as the full-year results from 25, the company relied heavily on its Model 3 and Model Y platforms to drive global scale, while expanding its energy storage division to support steady enterprise revenue. However, the older reports show that as legacy automakers introduced competing electric models and global consumer demand experienced a temporary plateau, the company had to engage in aggressive price discounting, which directly caused the compressed margins that bearish analysts frequently criticize today. This historic reliance on hardware sales is exactly what management is trying to break by pivoting the entire corporate structure towards subscription-based full self-driving software and decentralized fleet management. Looking ahead toward the future outlook, the stock faces a clear set of divergent scenarios that will continue to pit expectation against reality. The most immediate catalyst is the upcoming second quarter earnings report expected in late July, where Wall Street is projecting an estimated earnings per share of 42 cents. If the company reports numbers that fall short of this estimate due to ongoing heavy spending on data centers, we could see a quick reversal of today's gains as short-term traders exit their positions. Conversely, if the infrastructure build-out shows early signs of monetization, or if the broader autonomous network timeline accelerates, the stock could easily push toward the higher analyst targets near $500. Additional structural risks include the massive execution hurdles tied to scaling the Optimus humanoid robot project and navigating the complex global regulatory environment surrounding unsupervised autonomous transport systems. For long-term investors managing their money through platforms like SoFi Invest or a traditional individual brokerage with automated solutions like Schwab Intelligent Portfolios, this stock represents a unique challenge. It doesn't behave like Apple stock, which relies on predictable consumer upgrade cycles, nor does it perfectly mirror the pure hardware supply dynamics of Nvidia stock. Instead, it operates in a distinct category where corporate sentiment, founder dynamics, and multi-billion-dollar capital allocations dictate the daily price action. When you look at your overall online investing strategy, deciding whether to hold this asset requires looking past the daily noise of the Robinhood stock trading feeds and analyzing whether the massive $25 billion capital expenditure program will actually yield a dominant position in the next phase of computing. In summary, the central insights driving today's market action reveal a fascinating contrast between near-term operational realities and forward-looking market expectations. While the company is actively navigating compressed margins, negative free cash flow, and a costly pivot toward artificial intelligence infrastructure, institutional capital is aggressively bidding up the stock as a strategic proxy ahead of major broader ecosystem developments. The expectation was a quiet consolidation period defined by automotive headwinds, but the reality is a high-volume, institutional-driven breakout fueled by structural analyst upgrades and massive ecosystem re-ratings. This deep contrast between fundamental baseline metrics and forward-looking institutional positioning is exactly why the company continues to command absolute authority as one of the most heavily debated and actively traded assets in the modern financial landscape.